There was this wild time when all you had to do was add a .com to your company name, and it felt like you had a license to print money. A time when business plans were literally scribbled on napkins, and investors would just throw cash at ideas that hadn't made a single dime. That, my friends, was the .com bubble. It was a period of what they called irrational exuberance, and that phrase just hits the nail on the head. We're talking billions of dollars being poured into internet startups, which fueled this absolute frenzy that led to one of the most incredible market collapses in modern history. Trillions in value, just gone.
But this kind of begs the question, right? Was this whole boom and bust cycle just a massive, catastrophic failure? Or was this chaotic, explosive period actually the fire that was needed to forge the internet that we all use today?
All right, so let's dive in. Our story really starts in the mid-90s. The World Wide Web was just starting to move out of university labs and into people's homes. And for investors, well, they were starting to see the glimmer of a new digital gold rush. The rule of the game was simple. Forget profits. It was all about getting eyeballs. Things really started to heat up around 1995. You had the launch of the Netscape Navigator browser, which was huge. It suddenly made the web easy to use and showed Wall Street, hey, there's real money to be made here. So in the years that followed, venture capital just flooded the market, pushing the tech-heavy NASDAQ all the way to its insane peak in March of 2000. And the whole philosophy, the mantra of the time, was just get big fast. The goal wasn't to build some steady, profitable company. Oh no. The goal was to grab as much market share as you possibly could, as fast as you could. Everyone just kind of assumed that the profits, well, they'd magically show up later. And the scale of this mania was just staggering. I mean, the NASDAQ didn't just grow, it exploded. We're talking a 5-fold increase in just 5 years. It was the kind of growth that seemed to defy gravity, all fueled by this belief that the old rules of economics just didn't apply to the internet. This whole culture of excess meant companies were spending unbelievable amounts of money on things that had very little to do with their actual business. We saw these incredibly lavish offices, companies with zero revenue spending millions on Super Bowl ads, and of course, the infamous Pets.com sock puppet, which somehow became a national celebrity even while the company was just burning through cash. But a party this wild can't go on forever. And by the year 2000, you could really start to see the cracks forming. The money was running out, and gravity was about to remind everyone it existed in a really painful way. See, the business model for so many of these companies was just deeply, fundamentally flawed. It was all built on this idea of unsustainable growth. Think about it. If you're spending $2 to get a customer who's only ever going to spend $1 with you, you don't have a business. You have a really, really expensive hobby. And this is what happens when that reality finally hits. A few things happened in early 2000, like interest rate hikes, and that was the trigger for this massive loss of confidence. The sell-off wasn't a slow decline. No, it was a straight-up vertical drop. The bubble had officially popped. The final body count was just brutal. By the end of 2001, the NASDAQ had lost nearly 80% of its peak value. Trillions of dollars of wealth that had been built up over 5 years of hype just vanished. Poof. Gone. And the corporate casualties were everywhere you looked. Pets.com, the company with the famous sock puppet and the Super Bowl ad, it was liquidated just 9 months after that ad aired. It basically became the poster child for the whole .com bust. And then there was Webvan. Oh, Webvan. It had this massive vision to completely change how we get our groceries. It raised a ton of money, built all this huge infrastructure, and then proceeded to burn through over $800 million before completely collapsing into bankruptcy. So this all sounds like a complete and utter disaster, right? A cautionary tale about greed and hype? Well, not exactly. Because out of the ashes of that crash, something really remarkable started to happen. You see, the crash was kind of like this massive, brutal filter. You could even call it a Darwinian event for the internet. It wiped out all the weak ideas, all the poorly managed companies, and all the business models that just made no sense. But what was left behind was something much, much stronger. And you can see this great sorting happening. While companies like Pets.com and Webvan were completely wiped out, the resilient ones, the ones like Amazon and eBay, they survived. They used that nuclear winter after the crash to get lean, focus on what actually worked, and they came out the other side stronger than ever before. So for all its craziness, the bubble left behind this incredible inheritance. All that irrational investment money had actually built a massive physical infrastructure of fiber optic cables and data centers. It also taught an entire generation of people how to trust the internet, to shop online, to communicate online, to live online. This period literally laid the physical and the psychological foundation for everything that came next, from social media to the Netflix we binge every weekend. Okay, so what are the big lessons here? What are we supposed to take away from this incredible story of boom and bust? What did we actually learn from all that wreckage? It really boils down to three big things. First, substance always wins out over hype in the long run. A famous sock puppet is fun, but it's not a real business if you don't have a path to actually making money. Second, growth is just a strategy. It's not the end goal. Those underlying unit economics, that problem of spending $2 to make one, they have to work. And finally, you can never, ever underestimate the power of market psychology. Irrational exuberance is a very real and a very dangerous force. And this is exactly why this history matters. It leaves us with a really provocative question for today. When you look around at all the hype surrounding AI or other new technologies, do you see echoes of the dot-com era? Are we maybe ignoring the lessons of the past and living through a very similar kind of bubble right now? Definitely something to think about.